Today I have 7 tips, tricks and tools that will help you understand the trend strength. And this is very important because it will help you find bigger winning trades if you're able to find strong trending markets. It also helps you to get out of a trade when a trend is weakening so that you don't give back profits if you are trading trends. And you're also able to stay in trades longer to maximize your profits when a trend is ongoing. One of the best tools that you can use for trend trading are Bollinger Bands, and Bollinger Bands are perfect for that because they really help you understand trending markets. And what you will see is that during strong trending phases, impulsive waves, the market is able to get close and even sometimes outside of the Bollinger Bands, such as here and here, especially very strong impulsive wave, very close to the Bollinger Bands, sometimes even being able to push outside of it. And this is very different than what you will see during corrective waves. So here is a corrective wave and the market is not able to reach the opposite side of the Bollinger Bands. It is a squeeze here, you can see the Bollinger Bands are coming together, but at no point is the price action able to get into the opposite side. So that shows you we have a very strong trending phase, then a weak correction phase, and that makes a continuation so much more likely. And here as well we have the corrective wave, but it never reaches the opposite side. Granted, we don't move further much, but what happens afterwards is very different. You can see now we are pushing into the opposite Bollinger Band, and this could then start the new uptrend. So if you see that the market is changing that dynamic, and whereas the market was not able to push into the upper band previously, now this is changing. That should be a very big red flag. And if you're trading short, consider taking profits and maybe even start looking for bullish opportunities. During a strong trend, this is a very common phenomena. Sometimes the market is not able to push into the outer band. Sometimes the market is not even able to push below the mid band. So here you can see we have a very strong trending phase and the market is continuously staying above the middle band and here below the outer band, sometimes even getting outside of it. And this changes then right here at the top. We have lower highs, 3 lower highs. We are breaking here below the middle band and we are pushing into the outer band, and this is considered a Bollinger Band reversal. So we have a very strong trend shift. We go from trading here outside of the bands at the opposite side to then pushing into the lower bands, and then you can see we are starting here the downtrending phase. Another example, we have a strong trending phase here where we go from trading into the lower bands to all the way crossing into the upper bands. We have a little bit of a trend push. We have a very weak correction phase. You can see the correction is not even breaking here the middle band. And then we are continuing the uptrend into the outer bands. So Bollinger Bands are just the perfect tool when it comes to trend following trading. If you are a trader who is anyway interested in flag trading, maybe pullback trading, anything that is corrective wave trading, and you want to find more impulsive waves, trend following trades, consider using the Bollinger Bands. Another one of my favorite tools is a moving average channel. And here I'm using 2 moving averages. Both are the 20 period. One is applied to the high and one is applied to the low. And then you will get this beautiful channel. And what you will see is that during trending markets, the market is riding those channels. So you can see here, during this downtrend, the market is staying below the moving average channel and not crossing into the opposite side, which does change here. You can see the market goes from trending to trading above the channel, and then we have a short corrective wave. Then we resume back into the initial trend wave. So having the moving average channel is very helpful. I've tested around with different periods, 20, 50, 10, and in my experience, the 20 periods work the best here. And you can very nicely follow the wave rhythm in a trending market using this channel. You can see we have this strong trending phase here. We have a small corrective wave here. So the market stays above the channel, but only for a short while. And if you put those waves into context, you can see very strong selling sequence here in the first part, then very weak buying. This makes a continuation to more selling so much more likely. This interplay between impulsive wave, very weak corrective wave, then the breakout back below the channel, and then we resume the downtrend. So really try testing out this channel. It works really well on all the markets. Of course, it only works in a trending market, but that's the case for every trend following tool. And you can also start interesting combinations. For example, we have the channel here, and then you can also add the stochastic here. And the stochastic is a trend continuation or a trend confirmation tool. It measures the strength of a trend. And what you will often see is that the market is staying here below 50 if you're in a downtrend. So here you can see the market is in a downtrend and the price and the stochastic is also below 50. So you can use that as a trend filter tool. Maybe only trade when the price is below the moving average and also here below the 50 level. That brings us to the stochastic, which is our third tool that we are observing here for trend strength understanding. And the most interesting thing about stochastic is actually overbought and oversold. And most of the traders are using it incorrectly. A lot of traders believe that when the stochastic is oversold, you go long. But this is exactly the opposite of what the stochastic is telling you. When the stochastic is oversold, that tells you the market is short, the market is very bearish. There's nothing that would indicate when the stochastic is oversold, you should go long. Nothing in the formula, nothing in the purpose of the stochastic tells you that. So the way you can use it is as a filter. For example, only trade short when the stochastic is below 50, or even some traders go short only when the stochastic is in oversold. And that could be a very good trend filter. And you will see the best trends, the longest trends, the strongest trends, they always move when the stochastic is oversold or overbought. And it's a very common phenomenon. You have here a strong bearish trending phase. You can see the market is moving lower. The stochastic is below 50. Here we have our corrective wave. We briefly get above 50 and then we resume immediately back below 50. So this is the natural way of how a corrective wave usually looks on the stochastic. Very short move above 50 and then immediately back below 50 as the corrective wave is turning into the impulsive wave. And then you can see here the market and the stochastic is below 50. We get another strong trend push. So really fascinating indicator. You can also use a higher time frame stochastic. So here we are on the 1 hour time frame. And this is the stochastic from the 4 hour. And then you can see this is where the stochastic dipped below 20. And then you can see it's oversold all the way. And you can see the market is trending lower. And the most important takeaway I think that you can have here with the stochastic is that overthink how you would use it. Do you think that oversold means buying? Do you think overbought means selling? Then it's really time to overthink that, and you may miss a lot of great trading opportunities because the stochastic is designed exactly for the opposite. So explore that and you will see the beauty of that. We can also use different types of moving averages, and instead of having a channel, we can also use, for example, the 20 and the 12 SMA. And especially if you're looking for a crossover trend following approach, that works really well. 12 and 20 are not the most short-term moving averages, but they react quite quickly, and that is usually a good starting place. And what you will see is that when you have a cross, then often in a trending market you have some really decent moves. It works really similar to the moving average channel, but in this case you have a crossover system, which some traders prefer. And then you can use this, you can do the same. You look for a cross, and then you trade into that direction if it's in the overall primary trend. Here, for example, we are looking at a downtrend, so it would only make sense that we only look for the bearish opportunities here. After a weak corrective wave, you can see you draw your flag pattern here, you have your breakout, the moving average cross happens here. You stay in the short trade until here where you have the opposite cross. You wait the corrective wave out. Here the market crosses back lower. We have a next impulsive wave. And that's a very good way of using the moving average crossover. And it works nice during trending markets. You can also add a third moving average. You don't only need to stay with two. So here we have the 12, 20 and the 8 period. And then you can use, you can do the same. You can have a trading system which more is in line with the conventional ribbon moving average system, where you only trade when the three are separating and showing into the same direction. And then here you can see when the fast moving averages cross, that is often then the first signal the market is going into a corrective wave. Once they separate again, then you have your bearish period again. So really interesting way of using it. If you use 3 moving averages, make sure they're not super far away from each other. Also, they should not be too close. So 12, 20 and 8 is usually some ratio that works quite well. The next tool, we cannot talk about trend trading if we don't also consider the ADX. And this is the ADX line. In TradingView, it's called either ADX or you can go for the DMI. It's essentially the same. And what you want to do is you look for an ADX that is above 25 and rising. Rising is important because it shows you that the trend is picking up. And a lot of traders are using this 25 threshold for trends. So if the ADX is below 25, you are in a trend, in a range market, in a sideways market. And if the price and the ADX gets above 25, you're looking at a trending market. And then you can see very often you have those nice trending phases that come with the rising ADX. If you see that the ADX is starting to make lower highs like here, then that should be a heads up. It shows you that a continuation is not super likely, as we'll see here. After the lower highs, the market rolled over, and now we're seeing the opposite signal. We have now a hook again. So if you see that the ADX is going from down to slightly pointing up, that shows you that a trend is accelerating. So it's a very important thing as well to note. And of course, you don't need any indicator. You can pick up any information from your price chart as well. So we can just study the waves, the high and low structure, and that drives everything. So we can look at the steepness, for example. Here you can see the market is very steep, very strong sell-off. We have then a weak corrective wave. The corrective wave, the market is still able to push lower. It's not able to get above the resistance. We have the next impulsive wave that draws or gets us below the lows. We have another weak phase here. And then as the market is breaking its first high, then we're rolling over. We have a double bottom. We make higher lows. And then this cycle turns around. We have the same again until we hit here the triple top. We have the failed breakout. We break below the first low. We make a significantly lower low. And then there's a good chance the market will roll over. In the beginning, I would really recommend to sometimes switch to the line graph and just jump through the different time frames. You will learn quite a lot by just analyzing the different time frames. Flags are also a great ideal pullback pattern. If you are into trend trading, always consider trading or at least studying flags. Especially what I would recommend in this context at a moving average, and look for flags into the moving average, or what also works really well is flags into a pivot point. I made many videos about pivot points. You can look them up on my YouTube channel. And what happens often is that you have those pullback flags into a pivot point. And if you see that the flag is hitting the pivot point as support, then often a next impulsive wave is coming. So here you can see we have 3 flag patterns. They all lead to continuations. And if we just follow this market, what you'll see after the third flag, we are moving into a triple top. At this point, we don't have a flag. And what happens here is that the market for an extended period of time goes sideways. This is not a good sign anymore if you're looking for a bullish continuation. Continuation patterns usually don't take too long. You can see the period where the market is in a flag is usually quite limited. And if you see that the market is spending a prolonged amount of time in a sideways period, then often this is not anymore the continuation signal, but very often the market is then rolling over into the downside. And the trend change is much more likely after a prolonged sideways market, especially in this context where the market has already risen for quite a bit. The higher the market is, more traders have profits, right? If you buy down here and the market goes up and up and up, at one point you really start considering taking profits. And as the market moves higher, more people are considering taking profits, especially if you then see you have the triple top, the market is not able to break higher. So more and more buyers are exiting the market, more sellers are coming in. That drives then the price lower. Then you have things like a break and retest. You have another attempt at the high. And at this point, it's very clear the market seems to have no power anymore in the bullish side. And now the reversal to the downside is likely. Then the picture changes. The bullish corrective waves are much shorter. The strong impulsive trend waves are very long. And the same picture here from the left is repeating itself on the right. So you can pick up a lot from just looking at price action. However, in my experience, and I've been trading for over 15 years, having an indicator can often be very beneficial. I've mentored many traders, and after suggesting using an indicator to a trader, very often they feel quite happy, they feel more confident in their trading, and it really supports their decision making. So let me know what you find the most interesting, what is something that you have not considered before, what is something that you want to try out in your trading. Let me know in the comments below, and I will look forward to hearing from you.